Hello everyone and welcome to today's comprehensive session on one of the most crucial aspects of GST, Input Tax Credit, commonly known as ITC. Today we're going to dive deep into a topic that forms the very backbone of the GST system. By the end of this lecture, you'll have a crystal clear understanding of what input tax credit means, why it's so important, and how it works in practice. Let me outline what we'll be covering today. We'll start with the meaning and importance of input tax credit, then move on to the eligibility criteria and conditions for claiming ITC. We'll also discuss the documentary requirements, understand the concept of reversal and re-availment of ITC, explore the time limits for both payment of invoices and availing ITC, learn about the order of ITC utilization, and finally, understand the various restrictions on ITC utilization. So let's begin this exciting journey into the world of input tax credit. Before we dive into the technical details, let me explain why input tax credit is so fundamental to the GST system. You see, ITC plays a pivotal role in making GST a true value added tax. Think of it this way. Imagine you're a manufacturer who buys raw materials, pays GST on them, then sells the finished product and collects GST from your customer. Without ITC, you'd be paying tax on tax, which is exactly what we call tax cascading. Input tax credit eliminates this problem by allowing you to claim credit for the taxes you've already paid on your inputs. This ensures that tax is collected at each stage of the supply chain, but businesses get credit for taxes paid at earlier stages. Now, input tax credit is truly a cornerstone of the GST regime. It enables seamless credit flow on goods and services across the entire supply chain. However, there are some exceptions, like supplies under the composition scheme, blocked credits, and exempt goods or services where ITC is not available. Let's start with the basics. What exactly is input tax? According to Section 262 of the GST Act, input tax in relation to a registered person means the CGST, SGST, IGST, or UGST charged on any supply of goods or services made to that person. Now, this definition is quite broad and includes several important components. First, it includes IGST charged on import of goods. So when you import something and pay IGST at customs, that becomes your input tax. Second, it includes tax payable under reverse charge mechanism under sections 9(3) and 9(4). This is when you as the recipient are liable to pay the tax instead of the supplier. However, there's one important exclusion. Tax paid under the composition levy is not considered as input tax. This makes sense because composition dealers cannot claim ITC anyway. Now, let me explain why input tax credit. First and foremost, ITC ensures efficiency in the tax system. It is so critical for the smooth functioning of the GST system. Second, it maintains the integrity of the tax system by ensuring transparency and accountability in tax processes because every transaction is tracked and verified. Third, ITC ensures tax neutrality by avoiding tax cascading. Without ITC, businesses would end up paying tax on tax, making goods and services unnecessarily expensive for the end consumer. Fourth, it promotes a streamlined supply chain. What I mean by this is that the tax burden doesn't accumulate at different stages of the supply chain. It flows seamlessly from one stage to another. And finally, it aligns perfectly with GST principles for a unified tax regime, ensuring compliance across the board. Businesses can focus on their core operations without worrying about the cascading effect of taxes. Now let's move to the heart of the matter. Who is eligible for input tax credit and under what conditions? According to Section 1601 of the GST Act, every registered person shall be entitled to take credit of input tax charged on any supply of goods or services made to him. But there are important conditions here. The goods or services must be used or intended to be used in the course of furtherance of his business. This is crucial. You can't claim ITC on personal expenses or goods bought for non-business purposes. When you are eligible, the ITC amount gets credited to your electronic credit ledger automatically. However, this is subject to various conditions and restrictions that are prescribed in the rules, and the credit must be taken in the manner specified in Section 49. Now let's see what the conditions are. According to Section 16.2, a registered person will be entitled to ITC on inward supplies only if all of the following 6 conditions are fulfilled. Let me walk you through each one. Condition 1. You must be in possession of valid tax-paying documents. This could be a tax invoice, debit note, or other documents prescribed in Rule 36(1). Condition 2. The details of your invoice or debit note must be furnished by the supplier in their GSTR1 and reflected in your GSTR2B. This ensures that the supplier has declared the supply to you. Condition 3. The ITC shown in your GSTR2B in respect of that supply must not be restricted. We'll discuss restrictions in detail later. Condition 4. You must have actually received the goods and/or services. This is a physical requirement. No goods, no credit. Condition 5. The tax charged on the inward supply must have been actually paid to the government by the supplier, either in cash or through their own admissible ITC subject to Section 41 provisions. And Condition 6. You must have furnished your return under GSTR 3B under Section 39. All 6 conditions must be met. Missing even one means no ITC for you. Let's talk about the documents you need to claim ITC. According to Section 16(2)(a) and Rule 36(1), you can avail ITC based on several types of documents. First, the most common one, tax invoice issued by the supplier under Section 31. This is your standard business invoice. Second, for imports, you need the bill of entry or any similar document prescribed under the Customs Act 1962. Third, for supplies under reverse charge mechanism from unregistered persons, you need an invoice issued by yourself as the recipient under Section 31(3)(f) plus proof of payment. Fourth, if you're dealing with an input service distributor, you need an invoice, credit note, or any document issued under Rule 54(1). And finally, you can use a debit note issued by the supplier under Section 34. Remember, having the right document is just the first step. All other conditions must also be satisfied. Now, let me walk you through a more detailed flow of conditions for availing ITC. This slide shows you the step-by-step process that must be followed. Starting with eligibility. A registered person can claim ITC only if certain sequential conditions are met. First, the invoice or debit note details must be furnished by the supplier in their GSTR1 or through the invoice furnishing facility, which we call IFF. This is the supplier's responsibility. They must declare the supply they've made to you. Next, these details must also be communicated to you, the recipient, via Form GSTR2B, which is an auto-generated ITC statement. Think of GSTR2B as your personalized statement, showing all the ITC available to you based on what suppliers have declared. And finally, the ITC shown in your GSTR2B must not be restricted. There are various restrictions that can apply, which we'll discuss in detail later in this session. This flow ensures complete transparency and prevents any mismatch between what the supplier declares and what the recipient claims. It's a foolproof system that maintains the integrity of the ITC mechanism. Now let me explain the crucial connection between GSTR1 invoice furnishing facility and GSTR2B. This is where many people get confused. GSTR1 is a monthly or quarterly statement where suppliers provide details of their outward supplies. The due date is the 11th of the succeeding month. IFF or Invoice Furnishing Facility is available under the QRMP scheme. It allows suppliers to furnish invoice details for the first 2 months of a quarter to pass on ITC to recipients without waiting for the quarterly GSTR1. GSTR2B is your auto-generated monthly ITC statement. It's populated from supplier data in GSTR1 or IFF. This statement contains details of inward supplies on which ITC is available, as well as supplies where ITC is restricted either wholly or partly. Here's the key point. If an invoice is not reflected in your current month's GSTR2B, you cannot claim ITC for that period. You'll have to wait until the supplier furnishes the required details and it appears in a subsequent GSTR2B. Now, there are certain situations where ITC will not be available for inward supplies, regardless of whether you meet other conditions. Let me explain these restrictions. First, new registrants, suppliers who are newly registered won't be able to pass on ITC during a specified period post-registration. Second, tax defaulters, suppliers who have defaulted in paying tax for a prescribed period cannot pass on ITC. Third, tax mismatch. If a supplier's output tax liability in GSTR1 or IFF exceeds the tax actually paid in GSTR3B beyond a prescribed limit, their ITC pass-on gets restricted. Fourth, excess ITC claimed. Suppliers who have claimed ITC exceeding the permissible amount as per GSTR2B face restrictions. Fifth, Rule 86B non-compliance. Suppliers who don't discharge their tax liability as per Section 49(12) and Rule 86B face restrictions. And finally, there may be other specified persons as prescribed by the GST Council. The key takeaway: always verify your supplier's compliance status. Let's discuss the requirement of actually receiving goods or services to claim ITC. The general rule under Section 16(2)(b) is straightforward. You can claim ITC only if you have received the goods and or services. For services, this is usually when the service is provided to you or to any person as directed by you and on your behalf. For goods, It's when goods are delivered to you or to any other person on your direction. This is what we call the bill to ship to model. There's also the concept of deemed supply. This happens when goods are transferred before or during movement, either by transfer of documents of title or otherwise. One important point about goods received in lots: if you receive goods in multiple lots or installments, you can claim ITC only upon receipt of the last lot or installment. Let me give you a practical example of the bill to ship to model to make this crystal clear. Suppose vendor ships goods directly to party C, but on B's direction and instruction. Here's what happens. From an ITC perspective, it's deemed that B has received the goods because the goods are delivered to a third party C on B's specific instructions, and there's a transfer of documents of title or similar arrangements confirming delivery on B's behalf. In this scenario, two supplies actually occur. First, from A to B, so A raises an invoice to B. Second, from B to C, so B raises an invoice to C. For ITC eligibility, B can claim ITC on the goods delivered to C based on the invoice raised by A to B. Similarly, C can claim ITC based on the invoice issued by B to C. This model is very common in business, especially in trading and distribution scenarios. Now, here's the crucial point about tax payment and self-assessment of ITC. A registered person can avail eligible ITC as self-assessed in their return. This self-assessed ITC gets credited to the electronic credit ledger immediately. However, there's a critical requirement under Section 16(2)(c). The supplier must have actually paid the tax charged on the goods or services supplied. This payment can be made either in cash or by utilizing the supplier's own ITC, subject to Section 41 provisions. What this means is that the supplier must genuinely discharge their tax liability to the government before you can benefit from the ITC. This provision ensures that the government's revenue is protected and prevents fraudulent ITC claims. Sometimes, situations arise where you need to reverse ITC you've already claimed. Let me explain when and how this happens under Section 41 and Rule 37A. The condition for reversal is this: if your supplier fails to file GSTR 3B for the relevant tax period by 30th September following the end of the financial year in which you availed ITC, then you must reverse that ITC. The timeline for reversal is strict. You must reverse the ITC in your GSTR 3B by 30th November of the same year. If you don't reverse the ITC by the specified time, you will have to pay the amount with interest under Section 50. But there's good news too. Re-availment is possible. If your supplier subsequently pays the tax and files GSTR 3B for the relevant period, you can re-avail the reversed ITC in a future GSTR 3B return. This mechanism ensures that ITC is available only when the corresponding tax has actually reached the government. Here's something very important that many businesses overlook: the 180-day payment rule. According to the second proviso to Section 16(2), read with Rule 37, you have exactly 180 days from the invoice date to make payment to your supplier. What happens if you fail to make payment within these 180 days? You must reverse the ITC claimed, proportional to the unpaid amount, and pay interest under Section 50 on the reversed ITC. The reversal must be done in your GSTR 3B for the tax period immediately following the 180-day period from the invoice date. However, there are some exceptions. This rule doesn't apply to supplies where tax is payable under reverse charge, deemed supplies without consideration under Schedule 1, or any additions to supply value per Section 15(2)(b), where you as the recipient incur the supplier's liabilities. Here's an important intersection between GST law and income tax law that you need to understand. Under Section 16(3), if you claim depreciation under the Income Tax Act 1961 on the tax component, that is the GST portion of the cost of capital goods or plant and machinery, then you cannot claim ITC on that same tax component under GST law. This is to prevent double benefit. You can't claim both depreciation on the tax amount under income tax and also claim ITC on the same amount under GST. You have to choose one or the other. This provision ensures there's no double dipping and maintains the integrity of both tax systems. Let's talk about the overall time limit for availing ITC under Section 16(4). ITC on invoices pertaining to a financial year or debit notes issued in a financial year can be availed until the earlier of two dates, either till 30th November of the succeeding financial year or the date of filing of your relevant annual return, which is Form GSTR 9. So if you have an invoice from FY 2023-24, you can claim ITC on it until 30th November 2024 or until you file your annual return for 2023-24, whichever is earlier. There's an important exception though. This time limit doesn't apply to cases where ITC is being re-availed after having been reversed earlier. In such cases, you can re-avail even after the normal time limit. Also note that for debit notes, we use the date of issuance of the debit note to determine the relevant financial year, not the date of the original invoice. Now, let's understand the order in which you must utilize your ITC credits. This is governed by Sections 49(5), 49A, 49B, Rule 88A and Circular number 98/17, 2019 GST. There are three clear steps. Step 1, utilization of IGST credit. First, IGST credit must be utilized entirely towards payment of IGST liability. Any remaining IGST credit can then be utilized towards payment of CGST and SGST, UTGST in any order or proportion. The key rule here is that entire IGST credit must be fully utilized before using ITC of CGST or SGST, UTGST. Step 2. Utilization of CGST credit. ITC of CGST must first be used towards payment of CGST liability. After exhausting CGST liability, any remaining CGST credit can be utilized towards payment of IGST liability. However, ITC of CGST cannot be utilized for payment of SGST, UTGST liability. Step 3. Utilization of SGST, UTGST credit. ITC of SGST, UTGST must first be used towards payment of SGST, UTGST liability. After exhausting this, remaining credit can be utilized towards payment of IGST liability, but only if the ITC of CGST has been fully utilized. ITC of SGST, UTGST cannot be utilized for payment of CGST liability. Let me walk you through this flowchart. To make the utilization order crystal clear, you start with checking if IGST credit is available. If yes, you first utilize IGST credit for IGST liability. If there's remaining IGST credit, you can utilize it for CGST or SGST, UTGST in any order. Then move to the next step. Next, check if CGST credit is available. If yes, first utilize CGST credit for CGST liability. If there's remaining CGST credit, utilize it for IGST, then move to the next step. Finally, check if SGST UTGST credit is available. If yes, first utilize it for SGST UTGST liability. If there's remaining credit, utilize it for IGST, but only after utilizing CGST credit fully. Remember the key restrictions. Entire IGST credit must be fully utilized before using CGST or SGST UTGST credits. CGST credit cannot pay SGST UTGST liability. SGST UTGST credit cannot pay CGST liability. Now let's discuss restrictions on ITC utilization under Rule 86A. This is where the tax authorities can block your ITC if they suspect fraud. The commissioner or an officer not below the rank of assistant commissioner can impose restrictions on your electronic credit ledger if they have reason to believe that ITC has been fraudulently claimed or is ineligible. What circumstances lead to such restrictions? Using invoices from non-existent suppliers, invoices from suppliers not operating from their registered location, invoices without actual receipt of goods or services, invoices where taxes weren't actually paid to the government, if your business is non-existent or operates outside your registered location, or if you lack valid documents for claiming ITC. When restrictions are imposed, your ITC gets blocked. You cannot use it for payment of GST liability, and you cannot get refunds of unutilized ITC. These restrictions can last for a maximum period of 1 year. However, the Commissioner can withdraw restrictions if satisfied that the conditions for imposing them no longer exist. Rule 86B imposes a different type of restriction. It limits the use of ITC for discharging output tax liability to ensure a minimum portion is paid in cash. This rule applies to registered persons with taxable supplies exceeding rupees 50 lakh in a month, excluding exempt supplies and zero rated supplies. Under this rule, ITC can be used to discharge a maximum of 99% of the output tax liability. The remaining 1% must be discharged through the electronic cash ledger, meaning you must pay at least 1% in cash. This rule ensures that there's always some cash component in tax payments, which helps the government track genuine business activities and prevents purely paper transactions. Fortunately, there are several exceptions to Rule 86B that provide relief to genuine taxpayers. First exception is for income tax payment. If the registered person, proprietor, managing director, any of two partners, whole-time directors, members of managing committees, or board of trustees have paid income tax exceeding rupees 1 lakh in each of the last 2 financial years under section 139(1), then Rule 86B doesn't apply. Second exception is for refund recipients. If you've received a refund of more than rupees 1 lakh in the preceding financial year for zero rated supplies made without payment of tax or supplies under inverted duty structure, then you're exempt. Third exception is for excess cash payment. If you've already paid more than 1% of total output tax liability through electronic cash ledger, cumulatively up to the said month in the current financial year, then the restriction doesn't apply. Note that GST paid under reverse charge is not considered here. Fourth exception covers specified registered persons like government departments, public sector undertakings, local authorities, and statutory bodies. And that brings us to the end of our session on GST input tax credit. Today we've covered the fundamental meaning and critical importance of ITC in the GST ecosystem. We've thoroughly examined the eligibility criteria and 6 essential conditions for claiming ITC, understood the documentary requirements and the crucial role of GST R2B. We've explored the mechanisms of reversal and reavailment, learned about the critical 180-day payment timeline and the overall time limits for availing ITC. We've mastered the 3-step order of ITC utilization and understood the various restrictions under Rules 86A and 86B, along with their exceptions. Input tax credit is truly the backbone of GST. It ensures seamless credit flow, prevents tax cascading, and maintains the integrity of our tax system. Understanding these concepts thoroughly will help you navigate the GST regime with confidence and ensure full compliance. Thank you for your attention, and I hope this session has provided you with valuable insights into the world of input tax credit.